Welcome to Markets Now. I'm Michelle Rook along with Kim Beadle with Paradigm Futures. We saw mixed trade in hogs and grains, mostly lower in the cattle market on Tuesday. And let's start off in the grains, Kent, and talk about this wheat market, which was the price leader, and how much of that was on some of these Black Sea export concerns. Get us up to date on that.
Yeah, well, what we're hearing out of the Black Sea is that no ships are being cleared to enter Ukrainian ports, nor have they been recently cleared to leave Ukrainian ports. Russians seem to be shutting down the corridor, even though they had supposedly agreed to a 2-month extension early last week. And as a result, that puts world wheat importers in quite a bind when you consider that the U.S. crop is only rated 31% good to excellent. Granted, it did improve on this week's crop progress report, but still, historically poor. Not much hard red winter that's going to be available for export given production where we see it. If you can't get grain out of the Ukraine, it's going to put a lot of importers in a real bind.
So corn got some spillover help from the wheat market, but how much of the corn rally was, one, follow through buying because we had a pretty decent close, and two, weather premium being put in?
Yeah, well, some of it is weather premium, some of it is technicals. We would note, from a technical standpoint, we are seeing bullish divergence in stochastics and RSIs. We did manage today to get on Tuesday to get a close above the 572 area. That was a previous contract low. So a nice technical close above that should be able to give us a little bit of follow through, potentially back up to $6. But it's the weather premium, I think, that's been the driver here of corn so far this week. We are seeing a forecast that is not going to give us any rain for the Corn Belt for at least 10 trading days, and then potentially out even 2 weeks. We're seeing warmer temperatures, very little rainfall. And while it's really maybe a little bit early to get too concerned about it, if this is a pattern that persists, it's certainly going to get traders' attention and result in some risk premium being put back into the December corn contract.
Yeah, I was going to say, we do not have much weather premium in this corn market right now, do we?
No, we really don't. In fact, the pullback in corn that we've seen so far this spring has taken us right down to the what I would call insurance window of the 75 to 85% coverage at a trend line yield. Our lows jabbed into that area here last week. And, it kind of leaves us in a situation where there's not a lot of incentive for growers to sell anything. And, probably does provide some incentive for buyers if they look at the markets historically and see how little time we tend to trade at that low a price, especially this early in the year. Probably a good place for end users to get a little bit of coverage.
I want to go back and ask you about whether corn as well as the wheat market, especially spring wheat, are we going to have problems getting those last acres planted in North Dakota? We're running up against those final planting dates. And what do you see for PP? Will the market recognize that?
Well, obviously PP has not been a major topic here on the setback, but
No.
As we look at crop progress report, we see that we have nearly half of the spring wheat crop left to plant, more than half of the corn crop left to plant, and we only have till May 25th for the corn, particularly to get in before the insurance deadline. When you look at soil moisture profile in North Dakota, you see a fairly large area, probably between Jamestown and Bismarck and Point South, that have had an awful lot of rainfall. And I know that's the area where progress is furthest behind. Given the fact that corn prices have fallen as far as they have, prevent plants certainly does seem like an economical option for some of those farmers. If I was to put an estimate on PP acres right now, I'd have to say it's going to probably be somewhere in the neighborhood of 500,000 to 1 million.
What about soybeans? A setback here today. Was that just profit taking after the rally yesterday? And what was the problem with meal? Because we were down pretty hard there today.
Well, with meal, I think you've got a couple of issues. First of all, you've got certainly a large Brazilian crop, some of which I think is going to find its way into the Argentine crush plants, with Argentina, of course, being one of the largest world meal and oil exporters. The other issue I think domestically here is hog prices, which just cannot get going here on a seasonal basis, and we've really pressed down on hog margins here as of late, and that could have some impact on on meal demand going forward. And so those are the two issues with meal. And yesterday, on Monday, we had a 35-cent rally in soybeans, but only a $2 or $3 rally in meal. It sort of set up Tuesday's trade for meal to be a lagger again, and was actually a leader to the downside. And that's why you ended up getting some profit taking in soybeans.
Yeah. What's it going to take to get November beans back above the $12 mark? Because, we've got December corn back above $5. That's been pretty good support. $12 psychologically is support, but we're not back above it.
Well, I think what you're going to have is crop condition ratings and weather, right? And one of the things that tends to be a hallmark about soybeans is they don't have that same great look to them early in the growing season. And so if you happen to sag a little bit on crop condition ratings, especially if we have 2 or 3 weeks of warmer, drier weather, that's where I think you might see after that first condition rating in June, you be able to get some sort of a weather-related rally in soybeans. And to be fair, I'd like to think that we could do better than $12. I think 12.5 or maybe even 13 could still be a potential sales point for American farmer.
Mostly lower day in the cattle market. Was that just consolidation continuing here, or was there some hedge pressure, or was there something fundamental that we were trading today?
Well, certainly a little bit of hedge pressure. We've seen some resistance at 165 against the June, and
right,
and close to 165 here against the August contract as well. I think that we seasonally, even in bull market years, have a little bit of a struggle in May and June, and we're due for a little pullback. Of course, we seem to have peaked out the cash markets here recently, and the product markets as well. So not surprising that we might get a little bit of a pullback in the futures. Longer term, however, I think that there's some real strong underlying support to the numbers that we're going to see coming at us. And we're more than likely going to make some new highs here as we move through the summer.
Yeah, especially with the future still at that pretty good discount to the cash.
Yes.
What are you thinking about this hog market? More new contract lows in those front months today. Really, is there a fundamental reason that we need to be this low, Kent, or is this just the funds continuing to push their leverage?
Yeah, well, of course, the funds are carrying a fairly historic short position. It covered a few contracts over the last few weeks, but nearly 40,000 contracts short is still historically large. You're not seeing the good, strong cash improvement that you would be hoping for. We have seen the index here crawl above $80. That just happened here on today's 2-day projections. But then you saw, the base level hogs, national base hog price drop yesterday by $3, and looks soft here again this morning. And so really, it's a tough situation for hogs. We need leadership out of the cash markets. We know that we're approaching the period of time where we would find summer peaks, and we're just barely scratching out cash market highs at the levels that we saw in March. It's
Wow.
very, very disappointing, and it's certainly helped keep the futures market pressured.
Yeah, and profit margins really tight, maybe negative. So
yeah, certainly negative as you pass the summer here and get out into fall and winter. Those margins are now looking like $10 to $15 a head negative at best.
Wow. All right. Thanks for your analysis as always. That is Beadle with Paradigm Futures. That's markets now.